Davi, let me throw up this chart to begin with, taking a look at the CSI 300 up about 1.3% yesterday. Fourth straight session of gains. MSCI China also up by over 1% as well. That record high, though, remaining elusive. It feels like we just keep running into that ceiling of resistance when it comes to this Chinese equity rally. Do you think there's further room to run?
Yes, I mean, certainly into 2021. I think, the optimism around not only Chinese equities, but global equities is pretty consensus now. But I think the difference is in the positioning. And certainly, I think you can see that when you look at foreign investors' holdings of Chinese equities and fixed income. We've been talking about this for a couple of years now, the need for investors to get more exposure towards Chinese equities, whether that's onshore or offshore, and fixed income as well, which has been a very strong theme for us, at least in iShares for 2020. The market is running very strongly at the moment. We've had a very strong Santa rally. So in terms of the short term, I'm not really too sure, but certainly into 2021, the expectation for 8% GDP growth. And I think, if you look at foreign investors' positioning, it is still slightly underweight versus benchmark for Chinese equities and fixed income. So yes, I expect that will continue into next year.
So, and that's really interesting to me, because all we talk about, when it comes to the future of the US-China relationship is the bifurcation theme, right? Bifurcation when it comes to trade, diplomacy, the economy, and tech. And you were saying because of that bifurcation, investors really need to assign a bigger part of their portfolio to what is, I assume, essentially going to become pure play China names.
Yeah, so I think this is probably the first time since the GFC where investors are looking for a new playbook for next year. And I think we're seeing that in regards to the flows currently. And that is, need to own things other than US S&P 500 and FANG tech names. And so, where do they actually look for growth? And I think it's certainly in Asia, and it's definitely in places like China. So yes, I think the message is quite clear. We're not saying you need to get out of U.S. growth or U.S. tech or U.S. equities in general. I think the message is you need to own both. And because the positioning in Chinese equities is much lower, that is where we think that the trend will be into 2021 and beyond.
What are the risks of more volatility given all of this decoupling that we're seeing between the two economies, and how that could affect market levels?
Well, I mean, if you look at Chinese equities, at least onshore, they are very much driven by retail investing, right? So about 85% of that turnover is retail investing. So the Chinese equity market tends to be less correlated to global equities and tends to be driven more by monetary policy onshore. So, we do think that the volatility can continue, particularly in regards to the geopolitical tensions between U.S. and China. As you mentioned, decoupling. We think that will continue, particularly in the tech space. But with the Joe Biden presidency, at least short-term volatility, I think will be somewhat more muted than with the Trump presidency. So, yes, there will be some volatility, but the expectation is that the short-term volatility will be lower with the Biden presidency.
Let's talk a little bit about some other risks that we could see in 2021, because we were speaking to former New York Fed President Bill Dudley yesterday, and he was telling us that inflation might be a greater danger because precisely we're no longer perceiving it as such. What are you seeing as a bigger macro risks heading into the next year?
Well, I think, for us, that is one of the biggest risks to the market. If you look at what has actually driven this market higher and what continues to drive the market higher is very much a liquidity-driven bull market, zero interest rates, negative interest rates globally. So the question is, what can actually stop that? And historically, it's always come from a spike in inflation, which can happen much quicker than the market expects. Now, going back to the 70s, that's generally been driven by a big spike in the price of oil. But with us coming out of this COVID situation, with a return to economic normalcy, and with the continuation of rates being lower and a big fiscal push into 2021 globally, I could certainly see the case for inflation spiking quicker than the market's expecting. And that's why we've been recommending to have some kind of inflation hedge in investor portfolios. So I think for us, that's probably the number one reason.
What are those hedges that you're recommending?
Yeah, so I think at the beginning of the year, it was more around owning gold in the portfolio. I think at this current level, 1880, I think that's probably a good level to get some gold exposure. The other areas really are in the tip space for fixed income, treasury inflation protection. And I think you can also do it through a sector allocation. So, we have been seeing more interest in commodities, hedging for inflation through owning some oil and gas exposure. And I think those are probably the three main areas that investors can do it, and the three main areas where we've been seeing flows to actually protect against inflation moving into 2021.